This is John. He opened his first investment account 6 months ago. No big speech, no fireworks, just a quiet tap on his phone. He had saved up for a while, read a few books, watched some videos. He knew he wouldn't get rich overnight, but he felt ready to start. And then, the headlines came. U.S. debt hits record levels. Markets crash on new geopolitical fears. Dollar collapse is imminent. At first, he scrolled past them, but then he started wondering. Did I just invest at the worst time possible? People around him were nervous. One friend moved all his money into cash. Another started buying canned food and gold coins. YouTube was full of voices yelling, "This is it! The bubble's bursting! Get out while you can!" It didn't help that the numbers looked scary. The U.S. owed over $35 trillion. China and the U.S. were in a trade war. And inflation? Still lurking in the background. John wasn't sure what to think, so he stopped scrolling and started researching. What he found surprised him. This kind of fear. It wasn't new. In 2008, people thought the entire financial system would collapse. In 2020, they thought the pandemic would end the global economy. In 2011, Europe was supposedly finished because of its debt crisis. Each time, the fear felt real. Each time, headlines screamed collapse. And each time, the markets eventually recovered. John realized something important. It's not about whether people are afraid. It's about what the markets actually do over time. And over time, they go up. Not in a straight line, not without pain, but they grow. Because people adapt, companies find solutions, and the world moves forward, even when it stumbles. That changed how John looked at the U.S. debt, too. Sure, $35 trillion sounds apocalyptic, but debt isn't just a number, it's a relationship. And the U.S. has something unique. It prints the global reserve currency. Most of the world still buys U.S. bonds. Japan, China, global banks, pension funds. Not because they love American politics, but because they trust the U.S. economy more than the alternatives. And when John looked deeper, he found another thing. The debt was growing, yes, but so was the economy. So were earnings, so were asset values. Debt in isolation doesn't crash a system. Mismanagement does. And so far, the system bends, but doesn't break. Then there was war, news about Taiwan, Gaza, Ukraine, talks of Cold War 2.0. Everyone acting like this time is truly different. But it always feels that way in the moment. During the Cold War, markets still rose. During oil shocks, financial crises, terrorist attacks, stocks fell, then recovered. Sometimes fast, sometimes slow. But historically, the only people who lost were those who panicked and never came back. That left John with a decision. He could sell everything, sit in cash, wait for the perfect moment to invest, whenever that would be. Or he could treat this chaos as a stress test, not just for the market, for himself. So John built a plan. Nothing fancy. A core of global stocks, some gold, short-term bonds, a small cash buffer, and a little room for risk. Some AI, maybe crypto, maybe emerging markets. Just enough to grow, not enough to sink. He didn't go all in. He didn't gamble. He automated. Monthly buys, same day, same amount. Boring? Maybe, but that was the point. Because John had seen enough to understand. Fear is constant. But so is recovery. And while other people waited for things to feel safe, John realized that safety never feels like opportunity. It's when things don't feel safe that markets offer the best potential returns. So he kept investing, quietly, calmly, even when the headlines got louder. And in doing that, John passed the test, not the market's test, his own. Because being an investor isn't about being fearless. It's about learning how to invest despite fear. And that's how wealth is built. Not in comfort, but in conviction. But John wanted to understand not just the headlines, but the history behind them. He found stories of investors from the 1970s dealing with double-digit inflation and oil embargoes. Markets dropped, interest rates soared, and yet, by the 1980s, long-term holders had doubled their wealth. Then there was the dot-com crash, the housing collapse, even COVID. When the world shut down and the S&P 500 lost a third of its value in weeks. Every time, the fear was real. But every time, the long view paid off. It reminded John that fear is not a sign to stop. It's a signal to think deeper. So he studied what smart investors do in uncertain times. Some move into cash, some shift toward safe haven assets. Gold, short-term bonds, defensive stocks. Not to run away from the market, but to hold ground while others lose theirs. John learned about portfolio resilience. Gold doesn't pay dividends, but it holds value when currencies wobble. Bonds may feel boring, but they provide stability when stocks swing. And cash? Cash is flexibility. John didn't abandon stocks, but he made sure his foundation could absorb shocks. Meanwhile, he watched others react. Some friends chased the next headline, buying when markets spiked, selling when they dipped, panicking with every whisper of bad news. Others did nothing, frozen, waiting for a safe time to invest, which never seemed to come. John saw the pattern. Reaction is noise. Strategy is signal. He wrote down a rule: never take advice from people who benefit from your fear. That included YouTubers selling doom, gurus pushing fear-based products, and media outlets paid by the click. Instead, he built a system, simple, repeatable, not chasing trends, but owning the market slowly, over time. And when he felt uncertain, because he still did, he returned to his plan. He reminded himself why he owned what he owned. He adjusted when needed, but never out of panic. He started measuring progress not by daily gains, but by habits. Did I invest this month? Did I follow my rules? Did I learn something new? That's how John reframed investing, not as a race, not as a bet, but as a lifelong skill, one built on resilience, not reactions, on discipline, not drama. And in a world full of fear, debt, and war, that skill might be the most valuable asset of all.